One of the most common and popular things to invest in is REITs, or real estate investment trust. However, it is also one of the most misunderstood areas of investing. And in today's video, I will clarify the most important things about REITs that you need to know before you even put a dime into them. Owning a REIT, or real estate investment trust, can be a great alternative to owning physical real estate, such as a rental property. With REITs, you don't have to deal with the tenants, contracts, repairs, and even the down payment, because a REIT is trading exactly like any other stock, and you can simply invest whatever you want. There are also many benefits of owning REITs, and one of them is of course the really high dividend yield. REITs are able to generate a ton of monthly cash flow from all of their rental properties that they're renting out, and that makes them a great investment opportunity for those that are looking for high passive income. Secondly, then is REITs also an effective hedge against inflation, and that is because the price of a REIT or any physical real estate asset does follow the inflation. And third, then does REITs offer great diversification, as they do have a lower correlation with the stock market than many other things. And that does reduce the overall volatility of your investment portfolio. And fourth, then are REITs performing very well, and they have actually outperformed the S&P 500 index. So REITs does present themselves as being a really great investment option. But despite all of these benefits, then there are three things that investors must be aware of before you even put a dime into them. If you do like today's video, then don't forget to smash the like button below and subscribe to my channel for more weekly videos just like this one. With that being said, then let's jump straight to the first thing that you must be aware of. So the first thing that you need to understand about REITs is about the dividends. As I mentioned before, then one of the main benefits of investing into REITs is the massive amount of passive income in the form of dividends that you are able to receive. Let's take an example using Realty Income Corp. That is one of the most popular REITs there is. They are paying a dividend yield above 5, and that is actually very common amongst REITs, because REITs are required to pay out at least 90% of their total net income to their shareholders. However, here's when it gets really important, because the dividends that you receive from REITs are actually not your normal kind of dividends. They are known as distributions. And while there are tax benefits for dividends, then distributions don't have the same advantages, and they are taxed at your highest margin. And when considering the fact that most people are investing into REITs for this massive dividend payment or distribution, then this is something that could have a really huge impact on your overall stock market return. However, there is actually one way of getting around this if you're living in the US, and that is holding all of your REITs in your Roth IRA account. And in that way, then your distributions are going to be completely tax-free. And that is by far the best way to reap all of the benefits of having these high-paying dividend REITs in your portfolio. There is actually one more thing that investors need to be aware of. And as I mentioned before, then the REIT has to pay out at least 90% of their total earnings to their shareholders in the form of these distributions. What it means is that during bad economic times, it could be more likely that these companies cut their dividend payments. This is because when looking at their payout ratio, then in terms of their fund from operation, or FFO, which is actually supposed to be used instead of their earnings per share, then we actually find that their payout ratio is in the range of 70 to 90%. So if the earnings decrease by a factor of 10 to 30%, then will the REIT technically not be able to sustain the dividend over the long term? But how likely is it that their earnings will drop that far? Well, that all depends on what type of REIT you're investing into. Commercial REITs that own a lot of large office buildings with long-term leases of 10 to 30 years are probably a lot more safe than investing into REITs that own residential properties that have short-term leases of about 1 to 2 years. And having a REIT with a lot of cash on their balance sheet does help as well, as it means that they're able to sustain their dividend for a longer period of time. So these are some concerns that you as an investor must know before you even put a dime into a REIT, as they could have a really big impact on your overall return. So let's take a look at the second thing that investors must know before investing into REITs. One thing that does happen a lot is what's called share dilution. REITs are obligated to pay out at least 90% of their total earnings to their shareholders in the form of dividend payments or distributions. and that makes REITs unable to retain much cash flow that could be invested back into the business for future growth projects. Therefore, in order to grow, then REITs have to use debt or equity financing. So if you are a REIT owner and the REIT raises new equity as capital, then it basically means that your shares are gonna be diluted. And as a result of this, then we very often see REITs having an increased amount of shares outstanding over time, and that is very different compared to other companies. But is this really a major concern to investors? Well, clearly not, as we see so many REIT investors out there that are investing for those fat dividends. But one thing that you do need to know is that because of this share dilution, then will your dividend per share not grow as quick over time compared to other companies. Now, let's take a look at the third and final thing that you must understand before investing into REITs. If you are the type of investor that is looking for capital appreciation rather than consistent income, then the REITs might not be the perfect investment vehicle for you. Let's have a look at Realty Income Corp again, which is one of the most popular REITs there is. They have over the last 10 years increased by 35%, while the S&P 500 index has increased by 165%. This doesn't mean that all REITs are unable to grow their share price, but for the majority of them, then they have a really hard time doing it compared to other companies. And here's why. As we all know by now, then REITs are obligated to pay out at least 90% of their net earnings to their shareholders in the form of dividends. And that does mean that the REIT can take a lot of cash themselves and reinvest back into the business in order to grow through capital appreciation. Additionally, then we also find the effects of share dilution to increase the share price of the existing shares, and thereby making it even harder for them to grow their share price. Often we see companies doing what is called a share repurchase, and that is where the company is buying back their own shares in order to reduce the amount of outstanding shares, and that should in return improve the price per share. The opposite can then be true for any REIT, that their cash flow and their earnings may increase over time, but their cash flow per share and their earnings per share may decrease over time. And that is one of the main reasons as to why many REITs don't see the same capital appreciation as other companies does. That wraps up today's video. I hope that you enjoyed today's video, and if you did, then don't forget to smash the like button below and subscribe to my channel for more weekly videos just like this one. See you in the next one.